everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, I'm doing good. We've got a great guest today. He's going to be dispelling a couple of real estate myths about multifamily. It's going to be a good show, Jake. Let's get it rolling.
We got a real deal coming on the show. That's what I'm going to tell you right now. So today's guest is John Cohen. John is a multifamily investor from Long Island, New York, and is responsible for the day-to-day operations of Toro Real Estate Partners, including investment strategy, acquisitions, dispositions, and asset management. Prior to his investing career, John was a real estate broker for Marcus and Millichap. So without further ado, John, welcome to the show.
Hey guys, how are you?
Doing great. So tell us about that jump, going from broker to investor and why you made the move.
Yeah, so it was an easy choice for me. When I was a broker, I just saw what my clients were doing, and this started prior to the Marcus days. Even when I was a residential broker in the city, I just saw the money they were making on the passive side, and realized that I was only as good as my last deal. So on the residential side, you're just deal after deal after deal, and there's no income coming in if you stop working. And then on the commercial side, when you build relationships with some, professional groups like ourselves, and, it could be repeat business, but it's not passive income. And then just interviewing and talking to some of my clients, I just knew what I wanted to do, and made the transition onto the other side, just starting small and then, working my way up to multifamily.
So let me ask you the first question. Why do more brokers do that?
It's a great question, and I'll keep names off the record, but I was actually having a conversation with a broker friend of mine, and he actually told me it's done not the right way. We just bought a deal recently, and we found out that the broker that sold it to us actually had an ownership in the deal 24 hours before it's supposed to close, and nothing was ever disclosed to us. Not that it wasn't the end of the world, but I guess it does happen on the DL a little bit more than it should. Or I know from my Marcus days, some guys there were buying deals, cold calling, picking up the phone. A guy said, "I'll sell it to you for $600,000." They would put it under contract and flip it to clients. So I think it happens on the DL, and it's not supposed to. But be that as it may, I don't know why brokers don't make the transition. More 100% involved.
Limiting beliefs, right, Gino?
Yeah, explain to me what DL is for listeners, just in case they don't know.
Down low. Someone probably doing something they shouldn't be doing, or want anyone to know about.
So this is what I want to know, because a lot of our Jake and Gino members are residential brokers. How do they make that transition from going to a broker to becoming an investor? Because it's really important. I see it every day. Like Kiyosaki says, brokers are a broker than you and me. So walk me through what you think it takes to move from that side to the investor side.
I think the first thing it takes is definitely confidence and losing the fear, because people don't want to make a mistake. But one of the best deals I did was the first deal I did, where I lost $300 because I had no idea what I was doing. But it showed me that I can I can do this, and that didn't kill me, it didn't crush me. Or two other ways is not only educating yourself, but also getting involved in any way, shape, or form, and learning a little bit more. And then the third way, and patting myself on the back, you guys as well. If you wanted to get involved in a syndication or investing in a larger deal as a little bit, as a member, and learning a little bit more, and then going through that process, and then taking the slow steps to get to owning a couple properties or owning one property, whatever you're looking to do.
So how did you get into that first deal? Let's talk about that first deal.
So it was I was a stockbroker. Didn't like my job. Luckily, I was relatively successful at it, so I was able to save some money. And I would go into work sitting on the computer just reading every single book, every single article out there. And tax deeds were something that was interesting to me, because I figured, okay, I could buy these things for relatively cheap. And I just read a couple books, bought a $2,000 program online, and then just started looking at counties and picked a county, went out to the auction, told myself it was an education. Don't buy anything, just sit there and learn. And then, the auction environment gets going, and next thing you know,
little testosterone, here we go.
And then next thing you know, you own a property that's worthless. So it is what it is, but it cost me a couple $100.
So let's define what a syndication is, and why did you look at syndication as I guess the model for investing?
So when I was a stockbroker, I had this epiphany, and I wake up. My dad's an attorney, and I was like, Dad, I got a great idea. I'm going to raise money like I do for being a stockbroker, but I'm going to go buy real estate deals. He's like, that's great, just 100% illegal. You can't just cold call people raising money, 7 years ago. It's still a gray area and consult an attorney. But I told him that. He's like, it's a great idea, but you can't really do that the way you want to do that. So I think syndication is just a fancy way of saying, you're the one running the show or running a deal. But that idea, being a stockbroker, being a residential broker, being a commercial broker, I sort of hybrided the three and said, okay, this is what I'd like to accomplish. I'd like to raise money, buy multifamily properties, and run the show, where I could sort of use my background and my experience and put it all together. And, I sought out an advisor to help make sure I was doing it the right way. And, lo and behold, that's where I'm at today.
So where did you start your syndication, I guess, education, as far as because you're already working in the space, you already have an idea, maybe how to underwrite the deals and how to network and all, but where did you get, your education on syndication?
So I got my education from someone who's no longer doing education anymore, but he was referred to me through a very, very, very good family friend. I was working with his son and his son's two cousins on tax deed properties in Philadelphia. It was my grandpa's surprise 80th birthday party. He comes over to me. He's like, I really appreciate you working with my son. What have you been up to? I said, I just put an offer on a 44 unit out in Cleveland. And he said, hold off. I got to introduce you to my buddy. He introduced you to my friend, Chris Urso, who was a multifamily, coach, advisor, also owns
Chris has been on the show too.
Yeah, exactly. Yeah. So your listeners probably know he is. Super successful, definitely knows what he's doing. My very good friend, like an uncle, introduced me to him. I sat down with him, and I was just like, this is what I got to do. I paid what I had to pay, but I figured that was the cost of getting involved. I've already lost some money in some deals. I had a couple single-family rentals, and it just wasn't getting me where I wanted to go. So Chris was, awesome, taught me a lot, and really without him, I credit most of my success to him right now.
So where do you think people should start? I mean, in real estate, because that's the big myth. I don't have money. And I think Jake and I can attest to it now that we've done a few deals. It's not really about the money. It's more about the deal. So let's dispel that myth about money. I mean, where should people start?
I think the best way to start is not to be like every other, go to a local real estate investment club, talk to friends and family and bring them value. Show them something that they might not have access to, a multifamily deal or, an investor, and then start that process by getting involved, talking to people that do it, educating yourself, and then making an offer. You can't do real estate unless you make an offer. If you don't have money and you don't have an offer, you have nothing. So you need to have one or the other. So make an offer, forget being scared what might happen, make the offer, go through the process, and then, bring value to other people. So I think, to get started, with no money, that's a couple ways to do it.
So let's talk about the pros and cons of syndication. I mean, what do you love about syndication and what do you hate about syndication?
Oh, that's a great question. What I love about it, is probably what I hate about it. The two things that I'm always spinning are obviously looking for investors and looking for deals. That the asset management, the management side of the deal, not significantly easier than you may think, but looking for deals and looking for investors. So spinning those two things it's a constant balance, and it's fun and it's exciting. Where's the next deal coming? Where's that next investor coming from? The things I hate about syndication, I would say the investor relations. I wish I was a billionaire and I could buy deals for myself and I only had to answer to myself. But that comes with the territory. So it's just not that answering to investors and just being at their beck and call is a problem. It's probably my least favorite part of it. And if I had all the money in the world, I'd buy deals for myself because my expectations are a lot lower. So I'll take lower returns than some investors. But I would say the best part is just, the constant challenge or where to find the next deal or how to be different than everyone else doing this and, what value you could bring to a property. The negative is just, answering to people.
But on the flip side, they're pushing you, making sure you're keeping it tight and pushing things along in the best direction possible. So, it's got its benefits too, right? Keeping you on your
100%.
toes. Yeah.
100%. Exactly. And, that answering the question, that's a negative. But, it's definitely, an awesome part when an investor calls you up and has a question or a tricky question or doesn't understand something, that sparks up conversation internally in our office and in my own head. And it's, okay, how can we do this better?
So it's making you better.
Absolutely.
Yep.
So let me ask you, before we get into the framework of syndication, how you put a syndication together, steps from A to Z, how do you look for investors? I mean, what do you do to go out and investors as far as networking, as far as trying to get a credibility kit together? What do you do to really network with investors?
Great point. The one piece of advice that I tell everyone when they first ask me that question, it's about networking. Now, just going to a networking event, going over to somebody there and saying, hey, give me $100,000 is probably not going to work. Give me $1 million, it's not going to work. So what I try and do every month is I try and meet 30 new people at whatever event it may be, and I try and build a relationship with them over time. Just, how can I add value to them? Sitting down with them, coffee, lunch, Starbucks, whatever it is, just getting to meet 30 new people. Because if you do that every month, that's 360 new people in your database every single year, and that can build and build and build. And then on top of that, when you first start, it's definitely talking to your friends and family, close contacts, and trying to add value to them, bringing them something that they didn't know existed, and or bringing them another return, a diversification.
How much did you raise on your first deal?
First deal we raised $580,000, and that was it was my deal. I didn't have the balance sheet for it, so I brought in a partner to help with the balance sheet, and it was $580,000 in equity. Total all-in cost for the deal was about $1.4 million.
So, guys, that's the way to do it. He partnered and he raised money. So those are the two ways to dispel it. Listen, 10% of a pie is better than 100% of nothing, right? As I get older, that makes a lot of sense. He's scaling up a lot quicker, so maybe he doesn't own the whole deal, but he can get into a lot more deals. His balance sheet will look better. His credibility will look better. And, the question I guess I can bounce off of that one is, how did you overcome those limiting beliefs that everyone has? Well, everyone always asks me, I don't have any credibility to do my first deal. Jake and I really didn't. I don't know how we did our first deal, but how did you overcome that lack of credibility to get that first deal and to raise $600,000 on your first deal? That's pretty awesome.
Yeah, I would say that the one thing that I, definitely being confident, for sure. I always thought that raising money wouldn't be a problem. And, that deal taught me a lesson because I raised the money 3 times. The first time the guy committed, needed his money back. The second time the guy actually sent the money and then called me back in a panic, needed it back. So I had to send him back the money. So I was like, okay, this is a little bit harder than
different guys?
Different guys, 2 totally different guys.
Oh, come on, man. You're just getting just juiced in the gut.
Yes, and luckily the seller just had no idea what was going on. It was an out-of-state guy who just didn't care. So the time was on my side. And then the third time we ended up with about 20 investors in the deal. So I was like, okay. I went from one
it's
to
brutal.
20. But
and you hung in there and you got it done, man. That's awesome.
Exactly. Thank you. But I would say it's a confidence, just being confident. And also it's not what you say, it's how you say it. That's a secret, tip of advice I tell people all the time. If you have no experience, find a way to get experience. Find a partner with experience. It's how you say what you've done in your history to parlay into giving people confidence about you. That's why you can't start with, complete strangers, because they don't know you. And if you don't have a nice 15-page credibility package of what you've done, it's going to be a lot harder. When you start friends and family, it makes it a lot easier. Now, people say, my friends have no money. Well,
get some new friends.
Okay, change your friends, exactly. No, but you got to start somewhere, and you got to get them believing in you and build off of that. That's what I would say about that.
Would you recommend to people starting on a smaller deal? We started with 25 units, Jake and I thought that was a nice size for us. We probably could have started smaller. Would you recommend to them, hey, start smaller, still get a partner, but learn how to underwrite, learn how to manage the things, and take it from there?
So that's a good question. And, it's easier to manage bigger deals. We have the smallest deal I have right now is an 8-unit. The largest deal we have is a 338 unit. Those deals they're easier to run. You have more professional management. Mm-hmm. And if I had to give one piece of recommendation, I would try and get people to start at the 100 number, because you just get a better quality of manager that can help you if something goes wrong, if you're not managing yourself, if you are out of state, if you are far away. But with that being said, you can't just put the blinders on and say we're only going to buy 200-unit properties. And if something, you gotta work both avenues. But I would say going bigger is a little bit easier. But then again, that also comes with your confidence in what you think you could raise. If you can't raise a bunch of money, then you can't do a 200-unit deal.
I agree with everything that you said. The only thing is you got to start somewhere, and some people just can't mentally get there. Right.
And you beat me to the punch. You brought it first. I was going to say, but where I would challenge myself is it's easy to say I'm only going to buy 150 units and then not buy a 10 unit or a 30 unit or a 50 unit. But if that deal comes into your inbox and it's exactly what you want, go make it happen. I
say that all day. I'm not 150 units. That's it. If you bring me an awesome 80 unit deal right now, I'm buying it today. Right. So, yeah. Anyways.
80, 40, bro. If we can find it. You know, you guys are both.
There's a duplex down the street, Gino. He's selling it for $25 a door. You want it?
Jake, we can flip it for 40. Why not? You know, it's what the market can give you. I'm learning that right down here right now.
Take what the defense gives you. Yeah.
And that's what you got to do in this market, and you have to adapt. And if that's what it's going to give you, you have to take it. If you can buy for 40 and flip it for 60, why not? I mean, that's not our model, but if that's what you can do, what you're talking about, I was just doing research on it as far as life coaching. It's all about self-concept. You're thinking about when you're getting your credibility, if you think you can do it, if you have a really good concept of yourself and you like yourself, you have the self-esteem, it's all about getting it done and really having that high self-concept. So that's one bit of advice. Listen, we all have to start somewhere. We're all beginners in the very beginning. But like you said, if you surround yourself with people who know what the heck they're doing, that's really one big leg up.
100%. You couldn't have said it any better.
Let me let's go through the whole framework of syndication. Let's go through that very first deal from A to Z. What did you do? How did you find the deal? How did you raise the money? How did you approach the investors? How did you close the deal? How did you take over? Start from the very beginning.
Gino, we only got like 10 more minutes here, bro. I'm just kidding. No, this is important. This is really good. This is good.
Yeah, I'll say. So the first deal came in, it was a direct mail campaign. I was mailing out to a ton of different lists, and I did that for my single family days and even from my Marcus and Millichap days. So it started with a direct mail campaign that actually ended up getting to the property manager that I've been talking to. So I was talking to managers, brokers, owners, everybody I could possibly get my hands on. It took 6 months. 6 months of offers going. Talking to different people. And my property manager had 3 letters. He was moving offices, and he had 3 letters on his desk. And he basically said, "Hey, you're JC Property Group, right?" And that's the first company I had. I said, "Yeah, that's me." He said, "I have your deal. It's an owner out of California. His partner's from South Korea or one of the Koreas. Here you go." So he made an introduction. I spoke to the owner. The owner basically said, "I'm listing this property on Monday." It was Tuesday afternoon or Wednesday afternoon. I looked at plane tickets. I was like, well, I can't afford that. So I jumped in my car and drove 10 hours to Columbus, drove the property. On the way there, I was calling brokers, managers, setting up as many meetings as I could, and just made that trip well worth its time. Drove out there, got there, looked at the property, called the owner, said, I'll take it. Then got in my car and more or less drove home. But that was finding the deal.
Asking price.
He wanted 135. We bought it at $1,085,000.
And why was the deal attractive? What did it have that you liked about it?
It was a disaster. There was 70% occupied. Half the tenants were paying. There was down units everywhere. Out-of-state owner. There was a $275,000 tax lien on the property. There was violations on all the staircases. So I figured this is going to scare some people away. So that's what attracted me to it, where I said, okay, I could add value instantaneously just by filling up the units. And then the operations didn't go 100% according to plan, but that's what attracted me to it. I drove it. The area didn't scare me. It was a nice area, but it was just being so poorly run that I figured there's some opportunity here. Okay,
so you find a deal, you lock the deal down. How did you build a team in that market? What did you do as far as team members?
So luckily, the network that Chris Urso had, he put you in, there was a ton of people in his coaching program, and a lot of them had relationships out in Columbus. So because of that, I was able to make some warm introductions to some property managers, some brokers, some help in that market. Also, my property manager had some good relationships with some contractors to help fix the problems that were there. And then on the financing side, that was just actually a personal friend of mine a contact of mine, not a friend, a contact of mine who was actually working on a loan for my grandfather. And it was just a small world. We started talking, and once I mentioned who my grandfather was, and he knew him, he said, "Don't worry, I'll get your deal financed." And that's when he introduced me to the bank. And so that was our mortgage side, and then the on-site stuff was all done through the network I had, as well as the physical presence of the property manager.
So how did you get financing on this property? 70% occupied. Did you have to come up with more money out of pocket for this deal?
So we got one of the best loans that I've seen to date. We actually came up with it was 25% down, and then we brought the renovation dollars, and then we got a 25-year amortization, a 6-year fixed rate and it reset. The prepayment penalty reset after 3, so it was 2 points, 1 point, no point, and then that reset in year 4 to 210. But I was 25% down. It was an awesome loan, but it was recourse. So there was a recourse component to it, which getting involved, not where I would recommend, but we had to get a deal done. So we knew the risk we were getting ourselves into. The deal appraised for more than we bought it, and the loan was about $825,000. So we were 100% comfortable with what the value of the property was and where the loan was to take the recourse.
How many units was it?
It was 48 units.
And then how long did it take? How much money did it take to fix it, and how long did it take you to fix it?
So we got it. This was the ups and downs of the deal. We got it cranking within 60 to 90 days. We fixed all the staircases. We did the down units. We leased it up. But our property manager was horrible. Now, as much of a relationship that I thought I had with the guy and how good he presented himself, about 9 months later, he was fired. So, but he did a really good job for the first 90 days. But then it was the same thing was happening over and over and over again. It just, occupancy would go up, then the evictions would come. Occupancy would go up, the evictions would come. And every time we tried to strategize with him and sit down and talk and try and figure it out, he just kept giving us the same answers, that it's a rougher property, so on and so forth. The broker contact I had out there, a Marcus and Millichap broker, introduced me to a guy who had a ton of experience, worked at lifestyle communities, managed 5,000 units for them. He said, this guy's actually looking to build his business. Let him come in. So in month 8, I reached out to him. I said, hey, can you be my eyes and ears on the ground, because I'm not there and I don't trust my manager, but I can't fire him yet because we were just getting ready to sell the property. So he sort of got involved, helped out, went to the property, and then slowly but surely we fired him, and the other guy transitioned into his spot. And then that's when it really took off the property. We sold it 18 months after we bought it. But once he got involved, we stabilized it. We did what we wanted to do from the beginning. We fixed the whole exterior the right way and just cleaned out all the bad tenants. I basically said, take it down, take everybody out, let's start from scratch. So we basically hit the reset button and went through it one more time.
So how did you go about raising the money on this deal? I mean, like you said, there was a lot of trepidation, a lot of fear. Did you do any kind of webinars for people to see the property? Yep. You sent out letters. Just walk us through that piece.
It's basically, I started with friends and family, and none of them invested. So that was a
good practice, though.
Exactly, it was good practice. Sat down, took out some people. Let's get caught. I had one friend put in $5,000, and I was like, okay, well, we're making progress. Only need $575,000 left. And then I went to my Marcus and Millichap contacts, the guys that I knew owned multifamily, and I said, hey, you guys know me for a couple of years selling some buildings, buying some buildings. I'm doing it on my own. I had some success there. And then I just, started whittling down the contacts and just basically going through the whole thing. But I did the webinars, an executive summary, coffees, dinners, lunches, breakfasts. I tried to do group meetings too, 4 or 5 people come together. Let's sit down. Let's talk about this in like a presentation form. I reached out to everybody. Everybody I knew. I went through my contact A to Z and basically just started at A, worked my way down, and called everybody I knew.
So what was the time frame? Can you walk me through that time frame of when you lock the deal down, when you do your physical due diligence, your financial due diligence, legal due diligence, close the deal, take over? Give me a feeling on that.
As I mentioned earlier, we had a seller that sort of just mailed it in once we signed contracts. We signed contracts in April of 2016. No, April 2000. July 31st of 2015 we closed. We signed contracts in April. So for the first 30 days, he didn't send me one form of due diligence that I asked for. So leases, rent roll, work orders, whole night. He didn't send me anything. So 30 days in or 28 days in, he sends me a text saying, are you putting up more deposit money? I said, James, you got to check your email. The clock hasn't even started yet. And he was like, oh, that's not good. And so 30 days was like the trial period. That's when I sat down with as many investors as I could to see if I could even do this. And I just got turned down. But the clock didn't start yet. So I had a 60-day close in the contract with a 15-day extension. So I got a 30-day basically freebie. Then I started after that with the physical, once I got the documents, I went out there immediately. I was doing due diligence in May, physical, walking every unit. Came home, went through everything. I actually went back out for a second due diligence, same time, right around May or June-ish, just to button up some stuff. throughout the whole period of time. Prior to signing contracts, it was probably about 30 days with legal, just going back and forth with purchase price, this clause, that clause. So I would say it was probably a solid 15, 20 days of legal up front. We signed contracts, 30-day seller mistake. Then there's a 30-day physical inspection, and then 30 days to close.
So where do the sources of money come from? Was it self-directed IRA money? Was it friends? Like you said friends and investment. Where's that chunk of money coming from?
I would say 60% of it was cash, 40% of it was IRA. Self-directed IRAs and 401ks from people I knew, and then the rest of it was cash.
This is a big question. I know a lot of guys always ask this, and I don't even know how to answer it because we've never been put in this situation. But what's your recommendation? Do you look for the deals or do you raise the money? What's the first thing you should do?
You can never go wrong by trying to raise the money.
Okay.
But you're not going to get any money without a deal. So it's the cart before the horse, the chicken before the egg. But those are the two things you're always trying to spin. And what I tell people all the time, educate your potential investors today for a deal in the future, but talk to them about the money side of it today before that deal comes in. So you can never go wrong by overfunding or getting over commitments from potential investors. But at the same time, if you're telling someone you're going to have a deal from them in 8 months, guy doing. So you got to run both of them. But my one recommendation is start with the equity. Just start educating people about what you're looking to accomplish and what you're targeting, and then filter them the information on the markets, on the deals at the same time. But start with the equity and then bring the deals in, closely thereafter.
Let's get into the mindset of the syndicator. I mean, what are the fees involved in syndication, and how do you guys make money?
It's a great question. So we charge an acquisition fee, typically anywhere between 1 to 5%, and that's going to be the size of the deal. The bigger the deal goes, we're closer to the 1. Typically, you're in that 1 to 5%. That's to find the deal, all your time, all your efforts. We get an acquisition fee up front. We have an asset management fee for managing the deal and managing the manager, more or less. That's typically 1 to 2% of the gross collected rent. Then we get a piece of cash flow. We'll typically do 80-20 splits, 70-30 splits over a preferred return. So we'll do an 8% preferred return, and then we'll get a split on cash flow, and then we get pops. The splits change as we hit different thresholds and as we hit different hurdles. And then occasionally, we've done it one time, we have a construction management fee. But that's a ground-up development deal we're doing. So that's a little bit different than a traditional multifamily takeover.
So what happens when you sell the property? I mean, is your strategy at the end of 1 year, 2 years to either sell the strategy or refinance the property? What would you prefer to do on your deals?
So I would say in the market we're in today, it's harder to find those 3 to 5 year deals for a couple of reasons. One, the market's extremely frothy. We're definitely closer to the top than we are to the bottom. So the last 3 properties we bought, or 3 out of the 4 properties we bought, not including the ground up because it's a totally different deal, were all 10 and 12 year loans. So we bought those. We're going long. That's just a straight cash flow. That's a good, solid long-term deal, good markets, good fundamentals. Prior to that, I would say the deals we look to do were probably 3 to 5 year deals. Get in, reposition them, either refi or sell. Sell being the preferred choice. Refinance being if we don't hit our sale number, we'll refi out, get capital back, and then we'll hold for cash flow. And
then you keep your investors in once you refi it out, or you just pay them off?
It depends. If we can buy a deal at good enough value, we will just pay them off and get them out. But if, when we've been buying properties over the last 4 years, it's a little bit harder to find a deal with that much value to get them out. But, and also, my strat, I would love to get them out, but you do want to do the right thing for them so they keep investing with you. So you keep them in, maybe the split changes drastically, but you keep them in, give them some money, keep them happy.
Glad you said that, because my next question was, how do you keep your investors happy? I mean, your first deal, obviously it's just making money, but I mean also those touch points. Talk about how you communicate with them. Maybe you do a monthly newsletter. You send out a bulletin. You do a live call with them. Give me some idea of how you keep your investors happy and how you keep them wanting to give you back money, because you want that money repeated, right?
Exactly. So performance is obviously the best. If you perform and you do what you say you're going to do or better, investors are happy. But it doesn't stop there. Even if you perform great, you still got to keep them up. So we have an open line of communication. Our office door is always open. We encourage investors to come into the office, sit down, ask us questions, shoot us an email. Also, when we do trips to go tour our deals, it's an open invite for investors. We say, hey, you guys, you're more than welcome to come down and look at the property you own. But on top of that, We do quarterly updates, semi-annual distributions after renovations are done. But, we're typically trying to stay in contact with them on a monthly basis, whether that's a quick email, what's going on, a quick, check out this article about South Carolina. So we'll do, a monthly email, quarterly webinars. On the quarterly webinar, it'll either be a call or a webinar depending on which deal it is and the heavy lifting of the deal. But that's the big one, just, doing what you say you're going to do and following through with it.
We haven't touched on this. I'd like to maybe just jump into what type of investor are you targeting? Accredited, sophisticated? Who are you targeting? And how can you target them? And how can you actually, market to them in this environment?
So that's a good question. That's where I've spent probably the last 12 to 18 months has all been on the family office institutional capital. So I've spent a lot of time over the last year and a half focusing in that space. Prior to that, we were targeting friends, family, and trying to get as many accredited investors as we could, starting there because of the securities law side of it. So you got to do your best you can on that side. But now we're typically targeting accredited investors that can invest a minimum of $100,000. That's also fluctuates depending on deal. But I've spent a lot of time trying to network in family office and institutional space. We just got our first institutional investor on our last deal, so my time's paid off. But definitely trying to focus on that. The higher net worth accredited is the recommendation I would give anyone out of the box.
And what were the guys you got in your first deal? Were they accredited, the first guys, or were they sophisticated?
50-50. I would say 50-50 accredited, 70-30 sophisticated, and then the balance, like a buddy of mine, just some people here and there to backfill whatever was left.
Mm-hmm. So what have you seen in this? I guess you touched on it a little bit before, but as far as underwriting these deals and the IRRs, like 3 years ago, I guess you guys were going to have 20 plus IRRs. What are the IRRs now, and what do you see going forward as far as underwriting the deals? And I guess one more question, flip side of that, are your investors okay with keeping money in with you for 10 years? Because I know 3 or 4 years ago, people wanted their money back real quick, and now all of a sudden I'm talking to investors and like, you can keep my money. I'm like, it's a complete switch for us.
Yeah, so that's a great point, and that comes down to the individual. We've educated our investors on the market as well as what the return expectations are, and we've set the bar on our past deals pretty high, but on future expectations, we said, listen, the market's changing. We got to adapt our strategy if we want to be competitive. 3 years ago, we were targeting nothing less than an 18 on an IRR. That was bare minimum. I wouldn't even look at the deal. Now, depending on the type of deal, we're sitting in that 12 to 15 IRR number. If it's a stable deal, be more of a B asset with a better class asset, not new construction. Investors are okay with cash on cashes of 8 to 12 and IRRs of 12 to 15. But the heavier lifting deals, they still want to see 15s minimum, where that used to be 18, 20. They've come down to the 15 number. But it depends on who your investors are, but definitely trying to keep their money for 10 years. It was a battle. That was the biggest negative I got back when we first did those 3 deals was, I don't know about that. That's a long time. And I said, well, that's our best option. It's going to give us the most loan proceeds. We're going to cash flow really well. The assets are in great locations, but it's tough. People want their money, 3 to 5 years or 2 to 5 years as quick as possible. So educating your investors and teaching them more about the market can help overcome that, but it was definitely a huge hurdle we had to get over.
So why do you think they want their money quicker? I mean, if you're raising 40, 50% of money from self-directed IRAs, what is the hurt? Is it just because it's just out of sight, out of mind? They want that money back, and they want to. What do you hear from investors?
So I would say that self-directed IRA side of it, they're more. I have this conversation with a couple of those investors. They're like, who cares? I can't touch it till I'm 70 years old. So they're more inclined to go long term, and those longer term deals have a little bit more self-directed money in them because. If it's $100,000, if it's $50,000, whatever that money is, they can't touch it. And if I can give them 12% cash on cash, 10% cash on cash, 8%, that's probably better than they were doing in the other vehicles it was invested in. So the self-directed guys definitely have more. They're more open to the 10-year strategy. The cash guys, I just think that's people they want their money. Everyone wants to have their money just in case. And I think that's the biggest challenge with them. But on the self-directed side, those guys definitely go long. And if they don't, then you're probably not educating them enough or giving them a good enough deal. So I just think that it was easier to overcome the hurdle with them than cash.
So you've scaled up in the last couple of years, real quick. How have you done it with your your teams and your systems and your business?
That's a great question. I think we just spent a lot of time doing stuff that people didn't want to do. The heavier lifting deals in today's market are a little bit scary, but the institutions and the family offices and the higher net worth guys, they understand that, and there's a risk reward premium to it. So we shifted our focus on the type of deal, and then on the flip side of that, we'll also still go after those 10-year deals that are just traditional deals that we've always done, just going a little bit longer. But I would say just being a little bit different, trying to do things different than every other syndicator, sponsor in this business. Just be a little different you can't buy on pro forma and future. You got to buy what's physically there, but put your spin on it and replicate what you've done in the past that's been successful.
So what is your best tip for anyone getting out there wanting to get into syndication?
Reach out to the people doing it, pick their brains, ask them questions, and just get involved. Get involved. Pick up the phone. Don't be scared to pick up the phone and make a phone call to myself, to you guys, to whoever it may be, or someone doing it in your area. Just don't be scared. Pick up the phone. Worst case scenario, you're not going to get them or they're going to hang. But that's probably unlikely.
What about a daily habit or weekly habit that makes you successful? What would you say your best habit for success is?
I would say writing down, not forgetting things. So, I have a pad next to my desk that I carry with me all the time, and just making sure the hard things get done when they're supposed to get done and not pushing them off to the back burner.
Right here, Gino, for the folks on YouTube, baby. Coach's sheet every week.
There you go.
Right next to me, bro.
You got to do it, right?
Got to go old school. You got to write it down because it's all about the subconscious. You want your hand writing on a piece of paper and getting it done. Put the phone away. Use the pen and paper,
hilarious.
bro.
Absolutely. I'm 30 years old, but I'm not a technology guy. I'm a pen and paper. It's just easier. I have it right there. I don't have to worry about finding them in the notes or whatever it may be.
You got three guys sitting here with the, over 1,000 apartment units. They're still writing everything down on a piece of paper. Okay, what about a real estate book or a business book for the listeners that besides everyone knows like Rich Dad and all that stuff? Anything that you've read recently? Anything to recommend?
Yeah, I would say the one thing is a book that I just recently read, and I know a ton of people talk about it, but it's a great book, and it just gets you focused more to the pen and paper type stuff. It really gets you focused on checking off the big thing item that you have to do. So I would say, that one, I recently read it, and I think it helps. I think it can be focused on real estate as well as business. I mean, you can use that in any way, shape, or form.
Gino, it's on deck. I'm not there yet, bro. So he's been like, you got to read it, man. I'm like, it's sitting. It's great. It's on deck. It's on deck.
It's an easy listen. As Jake doesn't read, as most of our listeners know. It's an easy listen. You'll knock it out in like 3 hours. Get on your bike and ride it.
Absolutely, that's what I did. When I travel to the sites and I go on site, I just throw my headset in, podcast or audiobook, and knock it out. And it's great.
I'm creeping up. I'm on speed 1.5 now, so I'm getting through them quicker, trying to be a little more efficient.
Yep.
Helps out. What project are you excited about right now? You said you're doing a little, getting your hands a little more dirty than you were. What do you got going on right now that you're pumped about?
So I think my favorite project right now, we're actually selling what was my favorite project. We're selling that deal. Actually should hit market hopefully this week or next. But the two things that I have on my table right now that I absolutely love. One is our 338 unit in Mobile, Alabama. It's a completely vacant building. It's our first institutional investor. So it checks off a lot of our boxes. Super heavy lift. It needs about $6.5 million to get it rented or to get it rent ready. And it's a little bit different. Mobile, a little bit more tertiary. A lot of good things going on. First institutional investor. It's our largest deal on a renovation side. So it's got a lot of moving parts, but I think that by far is what we're really focused on right now. And then the other thing is, we're actually rolling out internally a trip for potential, investors as well as potential people looking to get involved. We're going to take them down on site to a couple of our properties and walk them through markets, walk them through with our managers, with brokers and stuff like that. So that's in the mix of getting worked out.
Nice.
That's great. I like that.
What is the best way for listeners, investors to get a hold of you?
I would say email. I could get back to you pretty quickly. That's, my email address is John, John at Toro, TOROREP.com. And I know you guys will put it in the notes. And my phone number's on our website. Reach out, give us a call, leave us a voicemail if I don't get back to you, and I'll pretty much, I'll turn that around relatively quickly.
What's the website?
It's Toro TOROREP.com.
Okay, that'll be in the show notes too.
Very cool. Gino, you got anything else?
Yeah, well, I mean, just a couple of things. I always come back to dispelling those myths. So just when somebody says I don't have money, it's not the money. It's the education. It's the thoughts, and the money will come. That's the biggest takeaway I get with syndication. Syndication is a great way to start, great way to get into the business. And I'm glad John came on to show us, because I always wanted to do a really good podcast on how to syndicate a deal from start to finish.
I got one more for you. Hassam Naji, the guy that's always on like Fox Business and doing this. Did you meet him? Yeah, did you meet him when you were at Marcus or no?
I never met him personally, but he's excellent. He every time he would speak on anything, it was always on the TV, but I never physically met him one-on-one or anything like that.
He seems to think the ride's going to go on forever, though, and some of the other pundits are saying it might be coming to an end. Yeah, big time, bro.
Now, I can argue both sides of the coin. I think the fundamentals behind this market definitely drove it for as long as it did, and we're in a little bit of a lull right now. And I could see it, going for 3 to 5 more years. And on the flip side, just like any other skeptical person, I could easily see us being in this lull, or potentially a little bit worse for in the near future. But be that as it may.
How do you guard yourself against that? Now that I don't want to keep asking questions.
Rate lock, man. 35-35. Get that HUD business.
Yeah, exactly. I think it's understanding the potential and it's underwriting up front. When we look at a deal, we look at what happened in 2008, 2009, and that's our base case. So we underwrite to that. And if it makes sense today with those numbers, I don't think we'll ever be back there in the near future, I should say. So just having that as a base case model is okay. And we tell every investor, listen, this is worst case scenario in our opinion. Are we comfortable with that? So I think underwriting can protect you for your downside. So don't listen to the broker when he says 250 for reserves, because that's not true. Underwrite to safety, but you could kill a deal doing that as well. But if you're comfortable with it and your investors are comfortable with it, it'll protect your downside, because they can't say you never told us this.
JC is going to be down at our live event November 11th and 12th in Knoxville, talking about syndication. I want everyone, write that down, because this is going to be a great event. We're going to have all guys out there, so it's exciting. Somebody talking about syndication and giving you his tips. You're going to learn a lot more than you did in this 1 hour. So, guys, mark it on your calendar.
And this gives us an opportunity to have a beer now, instead of just doing this stuff over the Skype, right?
Exactly. Yes. It's been long enough. I'm excited, guys. I'm excited to get down there. Just meet people. And guys, I'm super easy to access. Anyone that's listening, don't ever hesitate to give me a call. Reach out to me. Anything I do to help anybody, let me know.
Appreciate it.
Thanks, guys.
All right, guys.
Thanks.
We'll see you.